and welcome to the launch episode of Big Deal, an initiative by CNBC TV 18 to keep you ahead of the curve in mergers and acquisitions and also in corporate finance space. Hi there, I'm Nisha Podar and here are the top headlines from the Deal Street. Government allows 100% foreign ownership in Indian airports from 49% cap earlier. Debt-laden GVK GMR may benefit. FDI cap in pharma companies has been allowed to 74% via automatic route, may aid inbound deals in the sector. Will the future fundraising and valuation dynamics change in the startup world with Nikesh Arora resigning from SoftBank? In a surprise move, Nikesh Arora, handpicked successor to Masayoshi Son at SoftBank, resigned this week, will continue for a year as an advisor. Wait for the mega telecom merger of Anil Ambani's Reliance Communications and Aircel gets longer. Reliance Communications says that will announce the deal shortly. Sources tell CNBC TV 18 it could take a couple of weeks more. In overseas deal, Twitter has acquired a London-based machine learning startup Magic Pony for $150 million. This buy is an attempt by Twitter to bolster its video and live streaming capabilities. Tech Mahindra's string of small acquisitions continue. Acquires a £45 million UK-based company, the Bio Agency. It specializes in digital transformation across several sectors. In capital market action, Mahanagar Gas IPO worth 1,000 crore rupees sees very strong subscription with high demand from retail investors. Prem Vatsa's Quest Corp to launch IPO next week to raise 400 crore rupees. All right, let's take it straight to what's piping hot on the deal street. Many say that debt-laden companies will provide maximum M&A opportunities this year. What has really changed after S4A guidelines by the Reserve Bank of India? Well, CNBC TV 18 was the first to report on the scheme for sustainable structuring of stressed assets, or S4A. Right after we broke this story, the stock reaction was phenomenal across the debt-laden companies and also the entire banking world, because it provided relief to both the promoters and the lenders in debt resolution efforts, especially with SDR, or strategic debt restructuring, really failing to show good results. Now today we have with us the best in the business and the ones in the thick of the action, joining us to tell us, will S4A facilitate deals and will stressed assets see investments which will help them in the revival process? Ajay Piramal, Cyril Shroff and Kishore Karat. Gentlemen, so good to have you on the show. Welcome to the show. And first, let's take it straight to the investor. Mr. Piramal, you are keenly observing the stressed assets situation, and you are a keen investor as well. Coming in from the promoter community, do you think that it is definitely going to work out this time around?
You know, it depends on each company. There are some promoters who have run the companies reasonably well, but the environment has become adverse around them. Let's take the case of steel industry itself. Just because of the excess capacity which China has had, there's been a lot of imports of steel into this country and the prices have come down, and this has resulted in that the steel industry and steel companies have not done well. So here you could say that it's more an industry problem. There are other cases where the industries are okay, some companies have done well, but the others have done badly, and it may be because of promoters, and that's where sometimes you need to change promoters. Also, there could be cases where they found that there's been some fraud committed by promoters, and you need to change it. So again, to paint one picture that these promoters are all bad is not good. At the same time, to say that you can't change promoters is also not the right way to look at it.
Very balanced view coming in from Mr. Piramal. I was actually expecting more support coming in for the promoter class, since you belong to that particular community. But coming to the lender side then, Mr. Karat, now that the promoters have been given a chance to really revive their company without being ousted from it, do you think that there will be lesser strategic deals now?
Okay, if you are asking about whether the deals will increase or reduce, let me tell you, actually it depends, because in existing earlier SDR also there was sustainable, unsustainable portion was there. The interest of the new investors or new promoters who wanted to get into this was depending on that sustainability of the business. So today also, the only difference in today's S4A and previous SDR is today the existing promoter is allowed now to continue even at the 50% conversion of his equity. So perhaps yes, because the existing promoter himself has been allowed to continue, the new investors who are willing to come or who want to come, perhaps they may not get any windows open to get into good businesses, rather the viable businesses, I would say.
So, Mr. Shroff, you being the deal maker, what's your view on deal dynamics? Will S4A facilitate more deals, and in which area?
I think it's going to be very helpful, because one of the key concerns of capital providers in the stressed asset space was who will manage. And there was an acknowledgement of the fact that a lot of these stressed assets arose not because of poor management, but because of extraneous situations, sort of industry cycles, regulatory changes, court decisions, etc. But the management was fundamentally competent and sound. So there may be a scope for continuing them, but just restructuring the balance sheet and making it work. So there are a large number of such situations. Equally, from the providers of such capital, whether it's stressed assets funds or private equity or otherwise, must realize that one of the biggest problems that they face is a lack of being able to find a third-party manager for this. So they are not managers of assets, they are providers of capital. So this interestingly fills in that gap of having a manager on a case-by-case basis and still doing the restructuring without necessarily throwing the promoter out.
But Mr. Shroff, do you not think that strategic deals will be far and few, and other private equity players as well as stressed asset funds will play a more active role now?
I think so, because it allows minority stakes being acquired. And these guidelines also contemplate both types of situations, where there is a change in promoter and where there is no change in promoter. The limitations, I think, are slightly different. I think one of the limitations is that these guidelines are available only where the business has achieved commercial production. So it at one stroke knocks out a lot of projects which are still under implementation, especially in the infrastructure, and that is where a large part of the stressed assets are sitting. So that's off the table. The second limitation is the fact that one of the triggers for these guidelines to apply is that after the segregation of the debt into Part A and Part B, namely sustainable debt and the other debt, there is a minimum threshold of 50% of the funded debt should be Part A. Now, that can be a challenge, because there are some businesses where very deep financial restructuring is required, and the sustainable debt after the TEV could be less than 50%. So that's off the table as well. So actually, whilst it liberalizes the approach, it's still quite narrow.
I will come to the constraints in a bit, but first to Mr. Piramal, who is keen on the stressed asset investments front. How soon will the fund be active from your end, Mr. Piramal? When do we see you really putting in money in the stressed assets?
So we have already started looking at investments, so to that sense you can say that we are active, but more speed will pick up, I think, for us in the next 6 months. And I see that this sector, it's all a learning process. We are just evolving into this space, if I would say so. And over time, I think we'll just get there.
All right, 6 months is the timeline given. Now, Mr. Shroff has had earlier pointed out an important bit is the limitations bit in S4A guidelines. Now, Mr. Karat, from your point of view, can you throw more light on that aspect of the new guidelines, and what are the limitations that you really see?
If I talk about this S4A scheme, I think regulators need to slightly tweak this to become a more operational one. Because that sustainable portion, today they are not allowed any kind of tinkering. They are saying that it has to be within the limited cash flow of next 6 months only. The future cash flow is not at all taken into consideration. There is no moratorium is to be given, no reduction in the rate of interest. So no relief is actually allowed on the sustainable portion. But if we allow little bit of flexible or little bit of tinkering of that sustainable portion, perhaps banker will be in a position to recover larger chunk of their debts by let's say either reducing the rate of interest or allowing the moratorium or even changing the schedule only to that portion. So then it becomes a practical. So I think this is one challenge which we'll have to deal with that when we are actually looking in implementation of this scheme.
Yeah, but Mr. Kharat, another clarification sought by most of the lenders is is it only for project financing and not for EPC companies, or can the EPC companies also avail of the relief package? Is there any clarification on that one?
Yeah, project finance, when it said project finance based, actually basically the first thing which came in our mind was whether the some businesses or some borrowers like EPC contractors, whether they would be actually covered or not. But I understand that RBI has already hinted that that everyone, rather whosoever would like to prove their sustainability within the scheme and bankers are comfortable to implement that scheme, they can do it.
All right, so those EPC companies also included. So it's a wider gamut of companies which can really come under the scheme of S4A, it seems, with that clarification. But one thing from the investor's point of view, and Mr. Piramal, of course, friction on valuation is always been a deal breaker, especially in this space. How much of a gap do you see at this point? Is that really coming in the way of deal making?
It's, it is also sector specific or company specific rather. How much is the write-off that the banks are willing to take in a particular situation? And how much is the write-off that we would like them to take? There still exists this gap. And it is again company specific. It also depends on each bank and the consortium of banks. So it's still early days, as I said.
Oh yes, Mr. Piramal, how much write-off has been really a constant issue and has been a deal breaker in many ways. It has many aspects to it. But coming to Mr. Kharat, sir, here I am not really blaming any party and not the lenders, but does the new regulation give you more ability to take the right haircut, and who decides what's the fair value here?
See, haircut has been actually a stumbling block. Because many times what happens, the bankers are not comfortable to take a huge haircuts. For obvious reasons, because nobody would like to book the losses. And then the viability of the project, once it is established, if the projects are viable and bankers feel that yes, they can recover their money, I think haircut again becomes then a rather stumbling block in this entire scheme. But in this new scheme, there is no possibility, rather bankers can reduce the possibility of taking actually haircut. We can convert 50% or unsustainable debt maximum up to 50% in various other instruments, which if we defer it, let us say OCDs are there or CRPS route is there, wherein we can defer the repayment by the borrowers, so the actual load will not be there on them. But when they revive, then at that time bankers get the chance to encash their haircuts.
All right, from the deal maker side, now I know, Mr. Shroff, you have been in touch with many iBankers when you have cracked many deals. Now, lenders aren't iBankers, but they have to do the work of iBankers when it comes to the stressed asset side, because they are the real interested parties. So there's a whole host of skill sets that they don't really inherently have. Are you seeing that, or any other issues which are there which need to be ironed out at this point?
So, I mean, some of the issues are, again, 70% of our banking sector is the public sector, and a lot of this debt is sitting there. The challenges faced by the public sector are, we know them very well. They have less flexibility to do such transactions. So that continues to be an overriding concern of how do you get these these are M&A transactions effectively, where you require a lot of flexibility to put, each M&A deal is different. It's a work of art. There's no sort of cookie cutter solutions for this. And in the absence of that flexibility, your ability to stitch together a deal and close it is necessarily limited. So that is the biggest, I think, challenge. And then there are these environmental issues about this regulation or that regulation or a sector regulation, which you have to get over. So while deal activity, I think, will go up, but much more needs to be done in order for the real flow to start.
All right, hold your thoughts there, gentlemen. So what's the epicenter of the M&A action? We'll tell you after the break on which sectors there could be more focus than the others, and will deal making really kickstart? Stay tuned to Big Deal.